What if Toronto's housing market isn't heading for a correction because it's already in one? Sales just hit their lowest March since 1998. Condo listings are at an all-time high, and prices are quietly slipping month over month. But the scary part, with unemployment rising and mortgage delinquencies ticking upwards, we might be closer to a forced selling wave than most people think. In this video, we're unpacking what's actually going on in Toronto's market, why some trends are starting to feel familiar, and more importantly, what does this all mean for you if you're buying, selling, or just sitting on the sidelines this spring? Because Toronto is entering a new phase and most people haven't even realized it yet. Real quick, if we haven't met, my name is Richard. I'm a Canadian real estate agent, and I break down what's really happening in the housing market. With data, insights, none of that fluff stuff. You can go find that somewhere else, because this channel is all about making Canadian real estate easier to understand, whether you're buying, selling, or just trying to make sense of it all. So if that sounds helpful, hit the like and subscribe button so you don't miss out on future videos. Before I tackle what's driving this shift we're seeing, let's get a better understanding of where the market is currently at. First thing I want to talk about is these sales, which fell another 2.4% in March, following a brutal 28.5% drop in February. That puts March activity down 25% year over year, officially the worst March for sales since 1998, which translated into both single-family homes and condos hitting a 20-year low of activity. Then when we jump over to new listings and inventory, new listings jumped 9.6% month over month and are now up 32% year over year. Condos hit an all-time high for March. With buyers pulling back and sellers flooding into the market, the sales to new listings ratio is at just 29%. The lowest reading since 1991. That's a stat worth remembering. And then moving over to active inventory, total inventory is up 89% compared to last year. Detached homes in the 416 area are up 160%. Then moving over to condo inventory, which is also set a record high for this time of year. Because let's face it, this is one of the fastest inventory builds we've seen in over a decade. And it's across every segment, resulting in buyers having more options and sellers having more competition. Then when we move over to prices, the MLS HPI dropped 1.4% in March, following a 1.5% drop in February, which translated into prices now down 3.8% year over year, and condos are leading this slide, down 4.8% year over year. Now, something I've talked about in previous reports is the power of sale listings, which added an additional 278 new listings in March. That number is trending upwards, and now with Toronto's unemployment now at 8.8%, it's likely to continue rising. Now hopping over to construction activity, dwellings under construction across the GTA fell for the third straight month, now down 9% from the peak of 2023. And then when we look at new condo sales, which was only 152 in previous months, that's down 95% from 2022. To put that into numbers, that's 4,000 new condo sales in the past year. Compare that to 36,000 sold at the peak, which when we look at the future of condo competition, there could be a crash because we're staring down a potential supply crunch by 2028 or 2029. So now that we have a clear picture of what's currently going on, let's zoom out and look at what's causing this reset. And one factor is labor market weakness. Ontario lost 28,000 jobs in March, most of them in the GTA, and that's a massive hit. And the broader story is even softer. Full-time jobs down 62,000 nationwide. The private sector jobs are down 48,000. Unemployment in Toronto has spiked to 8.8%, and it appears that the long-term unemployment is also rising. And unfortunately, that's what tends to drive up mortgage delinquencies over time. Then we have interest rates, which there was no cut in April, but one may be coming soon. Because despite the soft economic data, the Bank of Canada held rates steady in April. But with the economy slowing and inflation softening, rate cuts could start as early as June or July, as the markets are still betting on lower mortgage rates by the summer. That means we could be looking at insured mortgage rates at the high 2s or even low 3s by Q3, which would be a huge affordability shift, the key being if it happens. And I guess one good thing is that the affordability is improving. Yes, prices are falling, but affordability is improving as well. If rates drop as expected, monthly payments could be down 30% from the late 2023 highs. And at the same time, wage growth is at the highest it's been in 25 years. And we can't forget about the household saving rates that are also strong, which all sets the stage for buyers to come back when they feel confident in the market. But what I will add is the supply in the pipeline is shrinking. We're currently being flooded with listings, but new construction is falling sharply. Permits are down across Ontario. So once demand returns, there's a good potential for a shortage supply. Now we've talked about what's currently happening and what's driving these changes. But most importantly, now let's talk about what does this all mean for you. If you're a buyer, you got time, leverage, and options right now. But don't confuse today's soft market with long-term opportunity. If the rates drop this summer, that perfect buying window might close on you, especially in tight submarkets like Durham, York Regional, and parts of West End where listings can disappear fast. And so the advice is always get pre-approved now, tour properties, and watch for motivated sellers. If you're a seller, this is what you need to watch out for. This is not a market where you push price expectations. With inventory building fast, especially in the detached and condo segments, pricing too high will leave your home sitting. So stage well, price sharply, and be ready to negotiate. The homes that are moving right now are clean, move-in ready, and priced to reflect the current market conditions, not last year's. And if you're someone that's looking to invest here, the cash flow math on condos is tight, but it's improving. The condo cash flow index shows that for the first time since 2022, buyers at an 80% loan to value are seeing positive equity growth after principal repayment, even if monthly cash flow is still slightly negative. This could be an early opportunity, but timing matters. And to sum it all up as to what's happening in Toronto, sales are slow, inventory is rising fast, construction is falling behind, prices are grinding down, but affordability is quietly improving because Toronto's housing market is clearly in a reset mode, but that won't last forever, especially if rate cuts do kick in and demand comes back. So if you're thinking about making the move, this is the time to prepare and not panic. Plan smart, move early, and make the market work in your favor. And so if this update helps you see the market more clearly, give it a like and subscribe so you don't miss out on next month's report. And if you want to see how we got here, you can check out last month's Toronto report. I'm going to link that video right here. And while you watch that, I'm going to go fly some drones.